Good morning, options traders, and happy Friday, everyone. And today is June 5th, and the markets are off to a red-hot start after a better-than-expected jobs report. And I thought what would be kind of a fun thing here for Friday is to do a hypothetical, made-up newsletter that I'm going to call the Sunspot Newsletter. And it's generating phenomenal returns. And I'm doing this in response to a post that somebody had asked about a newsletter. And I'm not going to name names, that's not the important point, but they just wanted to know about the performance and if anybody knew anything about it. And I'm not here to knock newsletters. A lot of them are extremely good, super good insights from people who are very qualified. But I will go out to say that probably 95% of them, if not more, are run by people who have no trading experience, no financial experience, no economics experience, no market experience of any kind. They're marketing companies. They just go out there and throw out trades, and they know how to write sensational emails. So what I want to show here, in hopefully kind of a fun way, is that how I can make this hypothetical newsletter here look really good. Now also, it's not that far of a stretch, believe it or not. There are some newsletters out there that follow things like sunspots and the stars and astrology. So if there is one called this, it's purely by coincidence. But I'm just trying to make the point of how you could take a really wacky theory and still make sensational returns. So the first one that they do is they assume that every single trade is filled. So while I'm typing up my emails here for the day, I'm looking and I say, oh, there's a $50 call trading for 3. That looks good. And I put up a buy alert. And then a little bit later, whether it's a few minutes later or a couple of days later, something, it's trading for 330. And I go, oh, let's put up an email alert to sell. Why? Because I can now say it was a 10% return in 3 days, and I can advertise a 1,200% return. And so you're looking at this going, gee, if I'd invested $10,000, I'd have made $12,000 just on this trade right here. Well, that's assuming you invested the entire portfolio, which very few people do. So you have to look at what's the net effect on the entire portfolio, probably nothing. But the big problem here is that the newsletter assumes that everyone got filled. And that is just simply not true. First of all, when they type up the email, it's going to take them some time. A lot of times it has to go through compliance approval. Then it sits on a server, believe it or not, for hours before you get it. So that $3 price is long gone. Might be better, might be worse, but it's long gone. Now another problem is, and I think most of you know that in the financial markets we have a bid and an ask, whether we're talking about stocks or options, and there is a field usually on your platform that will be called the size. And here I'm using 10 by 10, and what it shows is the first number here corresponds to the bid, and the second number corresponds to the ask. And in options trading, what this means is that there are 10 contracts currently being bid for at 280, which means you and I could currently sell at 280. There are also 10 contracts that are offered for sale at 3, which means that you and I could buy at 3 right now. So when I'm typing up the newsletter here and I see that it's trading for 3, it doesn't mean that every single person in the world gets it for 3. I might have 5,000 subscribers. And as soon as just a handful start placing trades, believe me, these quotes will change. Also, a lot of market makers subscribe to the bigger newsletters for this very reason. And as soon as they see the alerts go out, you can bet that the prices are going to change. So it's absolutely, completely false to assume that just because the trader that puts out the alert saw it trading at 3, and then he sees it trading at 330, means that everybody could have gotten those prices. So how do they get around this? Well, in the fine print, they just say, we don't know what you're paying for commissions. We don't know if your broker's any good at executions. So we're going to ignore commissions and ignore the fact that there might be what's called some slippage or some variation in prices. We're just going to report the prices that our expert traders saw. Well, good luck. You're not going to get anything close to what they're putting out there for your alerts. Now, the second problem is that they assume you have unlimited money. So here's what I could do in my Sunspot newsletter. Let's buy the $50 call for 3. And then I say, oh, sorry, that one didn't work. Let's try this $40 put for 2. Nope, that one burned out. Let's try the 75 call, the 60 call, the 45 put. How about this $30 put for 5? No, that didn't work out. How about this one for 4? That didn't work out. Let's try this $80 call for 6. Boom, we hit. We actually made some pretty decent money. But when you see my sensational email go out the next month about all the money that we made, you're going, how come my portfolio is sinking? So you call up to complain and they'll say, well, did you trade every single recommendation that we put out? And you say, well, no, I didn't. I couldn't because I ran out of money. And they say, well, all bets are off. Our money back guarantee doesn't apply because you didn't follow every single trade that we posted. So yeah, you can obviously just throw lots and lots of trades out there and eventually something is going to stick. So this is sometimes what I call the rain dance fallacy. You can go out there and do a rain dance for 30 days and you're bound to get rain. It doesn't mean it caused it. And just because they can write an email and say, oh yes, we've got proof, we recommended this and look at all the money we made, doesn't mean that they were able to see it coming. They're just taking lots and lots of shots because they're looking for a sensational email. And this is why the better newsletters will create what's called a model portfolio. And what this does, they take a fixed number of dollars, let's say 10,000, 100,000, doesn't matter, but they leave it fixed. And if that number grows, it's only because it was organically grown, because they were making money from their trades. And if it's losing money, they're not going to assume that you're just going to redeposit some more money in here to bring it back up. You can only trade with the money in the model portfolio. So if I was losing money on all of these and I finally burned out of all of my money in the model portfolio and I want to buy this option down here when it's trading at 6, but I don't have $6 in the account, or at least as cash, I might need to come up here and sell this one that I initially paid $8 for that's now maybe trading for 6 or 7, and I can generate the cash to buy this one. But now the model portfolio is going to pick up a loss. But see, on most of these newsletters, they don't do that. They just sweep it under the carpet and say, oh, it was a loss, but look at the winners that we did. So again, the big mistake is that they just assume that everybody can trade every single recommendation that they put out without bound, and that's simply an unrealistic expectation, but that's what they do and that's how they make it work. So for problem number 3, what they do is they add returns. So let's say that you have $10,000 you're thinking of investing with this Sunspot newsletter, and I say that we made 50% on our first trade, and yeah, we had a little bit of a loser here, 10%, but overall we're up 40% for the month. And you go, man, that's great. I would have had $4,000, $10,000 account up 40%. Look at all the money I'm missing. Well, what's the reality? The reality is that I gained 50% on a $100 trade, and I lost 10% on a $10,000 trade, maybe a stock trade. So in dollar terms, I gained $50, I lost $1,000. I'm actually down $950 or 9.5%. There is no up 40% anything, but this is what they do. And this is just simply bad math. And they'll try to get around it by saying, oh, it's just out of convenience, or it's just easier for people to understand. Those are all excuses. The better portfolios will do what's called a dollar-weighted return. And that's a way of looking at kind of the chained effect of all of these trades and what would the net effect be on your portfolio in terms of dollars had you followed all of these trades. But as you can imagine, this is why most of them don't post it on the websites. Now, the last problem I want to bring up is one that I call a correlation problem. And this example I'm going to show is actually one that was popularized by a guy named John Allen Paulos, who used to be a CNBC commentator. I'm going to put a little bit of a spin on it, but it brings up a very interesting point. And let's say that we have 200 people in an investment club. And this investment club has a stable of 10 stocks that it typically chooses from. And within our investment club, we have 100 what we're going to call independents. People that don't really like the Sunspot newsletter, they go off and they just buy their own picks, but still out of these 10. But within our club, 100 of them follow the Sunspot newsletter. So let's say that these are the 10 stocks that we have to choose from every single week, and every single week it's kind of a different one that becomes a winner. So let's say for a particular week it is stock number 3. So for, let's say, this given week, that these are the numbers we get. And this is how it's going to work. every time. The independent people, we will have roughly 10 people who will pick the winning stock because they're just picking stocks at random. They should get 10% of them correct. So we would expect that 10 people in this club would have picked the winning stock. The Sunspot Newsletter, unless it picked the lucky stock here, picks 0. So this goes on week to week. That is until the Sunspot Newsletter happens to pick the lucky stock. So let's say that this is the week it also picks stock 3. Then what's going to happen? Now we're going to see 10 people who are the independents that got it right, but we're going to get all 100 people from the Sunspot Newsletter who get it right. So the newsletters can give the illusion that the frequency of wins are a lot greater. But it's not because they're necessarily any better. It's because when they do happen to get lucky, everybody is choosing that same stock. They're all correlated. They're all chained at the hip. They either sync together and have 0 winners, or they all win because they're all doing the same trade. So the problem is it just gives this illusion that the newsletter is somehow creating lots and lots of winners. So as I've talked about in so many videos, remember the key for success. First of all, remember that the market doesn't care what you think. You can think all day long that a stock is going to go up. That's not what makes it go up. It's because everybody else thought it was going to go up. So newsletters, even though they say that we're experts at predicting this or that, or the next stock, what they're really saying is that they assume that they can predict what everybody else thinks. It's just simply not possible. But then there's another problem. How are they doing it? Well, they use MACD, they use RSI, they use the same things that everybody else is using. And you cannot beat the averages by doing what the average trader does. But they're going to convince you that you can. And as I always tell people, for success, trade the markets, but you want to hedge your opinion. And the way you do that is with options. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.